Let's get going. We've got quite a few people on tonight, so thank you very much for joining us on a Thursday evening at 7 o'clock. It's obviously midway through the evening, so we'll try and get through this relatively quickly. The view that we'll take on everything that we touch on today is going to be a high-level view. We'll be talking about IFISAs, we'll be talking about investing into property loans, we'll be talking about peer-to-peer, all of it at a relatively high level. And throughout the webinar, we are going to be discussing all of these and how you can invest. And it's not designed for all investors investing in peer-to-peer or investing in higher risk asset classes, because your capital is at risk. You may lose all that you lend. It is designed for sophisticated and high net worth individuals. And what we're talking about today is not financial advice. So let's get going. So what we will talk about is the different types of ISAs, mainly looking at an IFISA against a cash ISA, the benefit of both options, because there are benefits to both options, and the obvious drawbacks to both. There'll be an overview of sourced capital and who we are as a business, and how you can invest with sourced capital, combining peer-to-peer lending with the ISA structure to gain tax-free returns. And then there'll be an invitation to our next webinar. This webinar is a series of 3 that we'll be doing on the lead up to the end of the tax year. Obviously, that being when your ISA allowances refresh or you potentially lose them. Throughout the webinar, it will be quite interactive, hopefully. Hopefully, there'll be a few questions that come through, and there'll be a bit of a live Q&A at the end, if anyone's held any questions right back to the end. So myself, I'm the Investor Relations Director at Source Capital. I've been with Source for the last 4 years now. I work with our high net worth and sophisticated investors to help them invest into property development loans, earning a return up to 12%. Throughout that journey, I've learned a lot from current investors and what their plans are and how they utilize different structures to, one, invest in better or different asset classes to that I was aware of previously, and also the structures that they employ to be able to be more tax efficient. And obviously, utilizing the ISAs effectively is one of the most tax efficient ways that you can invest. I've got over a decade of experience personally in investing, and that's through a wealth of different asset classes, through property, through stocks and shares, cryptos and commodities. And I kind of, like I said before, I've learned a lot from the investors that I work with, and I've utilized some of those methods to be able to earn an attractive return per annum. Sourced as a business, I know a lot of the attendees today have seen us as they are current investors with Source, but there's quite a few new faces, so we'll just jump into it. It should take a minute or so to run through the Source model. There's 4 separate arms of the Source model, which is part of the Sourced ecosystem that was founded by Stephen Moss, who's still the managing director today, in 2017. So the Source franchise is a training, education, and an all-around business in a box for anyone either in property currently or wanting to become a property professional. That then leads to our Source Properties arm. So deals that the franchisees find, the property professionals find, they're able to sell via a online portal through the Source Properties app. We then have the Source Developments, where we've currently got over £200 million worth of active developments throughout the UK. And we have the Source Capital arm, which is a fully FCA regulated peer-to-peer investment platform, which we'll be discussing today mainly rather than the other arms of the business. So on the registration page, there was a couple of questions really, and that was to gauge who's in the audience, because the webinar is often one way. You're talking to a screen, you don't get to know who's behind the other side of the screen. So part of the questionnaire was, have you invested or do you currently have an ISA portfolio? So the majority of people here today know what an ISA is. It's an individual savings account. That's what it stands for. It's designed to help individuals save in a tax efficient manner. So it was a scheme created by the government to allow investors to invest up to £20,000 per annum to boost their savings. The returns on their capital are completely tax-free, and you're able to build that up year after year after year. There's 4 different types of ISAs. Typically, these are from banks, building societies, and investment companies. You've got cash ISA, stocks and shares ISA, innovative finance ISA, and you also have a lifetime ISA that plugs into one of the first 2 that I mentioned. They all offer different benefits, different features, different reasons why investors would utilize them and why some investors don't utilize them. So we'll look at the drawbacks of an actual ISA itself, rather than looking at the individual ones for the time being. So you are restricted on what you can invest per annum. You're restricted to £20,000. A lot of the investors I work with are high net worth. They invest further than 20,000 individually per annum. So you are restricted in what you can put in. There's a limited amount of investment options. I mentioned it a second ago, you've got cash. So it's just similar to what you would have when the funds are in a bank account. They're just sat idle, earning very little per annum. If it's through a tax wrapper, the little that you earn is tax-free. You can invest into peer-to-peer through a IFISA, which we'll be talking mainly about. And you can invest in stocks and shares. That's really it. You can't do any weird and wonderful or any other property strategies within an ISA. It's quite restrictive in what you can do with it. And there's a consumer perception that ISAs are pointless. They're not really designed for investors that want to earn a larger return. And often they're overlooked by high net worth investors because they look at it as, oh, I can only put 20,000 in, I don't need to utilize it. But if that's effectively built up year after year, they can be so powerful, especially when you start to look at compounding interest. So have a look at the benefits of an ISA. As we mentioned it, and as you're probably more than aware, and that's probably the reason why you're on today, the returns are completely tax-free. So you don't pay any income tax, you don't pay any capital gains tax on the returns that you make through that year. And that doesn't matter if you're making 1% return or 1,000% return. It's always going to be tax-free through the ISA. You can build that ISA pot over the years. So I've got many investors which have got ISAs in excess of £250,000, £500,000. They've built that year on year on year, adding to the total that they have, including adding further contributions. And you can transfer that in between different providers. So if you're investing with one company and you wish to diversify into different companies, or the other way, you want to consolidate your investments into one company, you can do that and it stays within the tax wrapper. As I mentioned, you can diversify through different platforms, different asset classes. You can keep some liquid through a cash ISA. You can have some stored away for a few years through a fixed cash ISA. There's many different options that you can use with the ISA. Onto the types of ISA. Again, this is an overview, a quick run through of the 4 different types. Every ISA is limited to £20,000. Even if you're splitting that between one ISA and the next ISA and the next ISA, you've got an overall limit of 20,000. The risk profiles depend on the type of investment that you're making. It depends on the asset class. If you're looking at stocks and shares, it depends on the type of investment. If you're looking at a peer-to-peer investment, whether it's secured by property, whether it's a business loan, whether it's unsecured, whether it's got a company debenture, etc. The returns as well are quite varied. The cash ISA obviously is dictated by the Bank of England base rate. Stocks and shares, it depends on level of risk, it depends on if it's managed, it depends on what fees are in place, it depends if you're self-managing it. There's so many variables with the stocks and shares ISA return. Innovative finance ISA returns are more stable in terms of what they predict the outcome to be throughout the duration of the loans that you're involved in, generally between 5. That's gone up slightly over the last few months now. I don't think there's anyone providing innovative finance ISAs at less than probably 6-7% now. Your lifetime ISA, we're not really going to touch on. It's designed for people to either look to save for their first house or look to save for their retirement. We have done webinars in the past regarding lifetime ISAs, but today we're just focusing on cash versus IFISAs. So we'll jump into all the way through this. Again, I want to make it quite proactive and quite interactive between ourselves and the viewers. So there's a couple of questions that we'll launch. It helps me know who's in the room and how to quickly run through some aspects of it, of the webinar, and obviously spend time on other things. So the first one is just to know what type of ISAs that you've used before. So we've got an option here for cash ISAs, IFISAs, stocks and shares ISAs, lifetime ISAs. I'll leave it on for a few seconds just to get an understanding, because I will be probably spending a little bit of time talking through what an IFISA is, considering there's not many people which have utilised it as of yet. Yeah, I keep that on for another 5 seconds, just let a few more people enter a vote. Perfect. So split really. So we've got the majority of people which have used cash ISAs. I would say just over half of the people have utilised cash ISAs, with a handful of people really never using an ISA, which is great. I've got around about a third which have utilised IFISAs, and again around about half which have utilised stocks and shares ISAs. So the next slide was one that I'm happy that I put in. This is about an IFISA. What is it and how does it work really? So it's a form of an ISA. It's a type or a breed of ISA, which allows investors to invest into alternative finance forms. So peer-to-peer being the one mainly that's being utilised in the UK now. Previously, a few years ago, it was crowdfunding. However, peer-to-peer, a debt-based investment, offers more of a clear outline to that investment for investors. The IF stands for innovative finance. And the same as other ISAs, it provides a tax wrapper or a tax haven for investments into the peer-to-peer investments. Again, I think the majority of people are new to peer-to-peer that are in the room. So we'll talk through what peer-to-peer is. It's a direct form of lending money between individuals and businesses. So with ourselves, we're focused on property development loans. You can invest into a property development over a fixed time period for a fixed return. It's generally done through regulated platforms, which are a fintech space to allow investors to find opportunities, to invest into opportunities, and then have their returns passed back to them through the platform. So everything's done through an online portal. And it's quite interesting when I speak to a lot of clients and they're looking at how they find the platforms or how they choose which platform to invest into over the year or over the years that they're investing. So I'll put these on and then we'll run through them. So the first thing is, when you're looking at the platforms, what type of investments do they offer and what average term of investments are they? Are they short term, 6 to 24 months? Are they longer term, 3, 4, 5, 6 years? Do you have any control of where your money is? Is it going into a fund? Is it going into an auto deployment strategy? Or can you pick which type of project, which business, which asset that you want to be involved in? Can you diversify your investments, or will it automatically diversify your investments? Can you choose how many projects you wish to invest into so that you know when those returns are expected back to you, and then you can look at a reinvestment strategy? Do they conduct any due diligence for you, or do you need to conduct all of your own due diligence? If they're conducting due diligence, what do they provide to you as an investor? How transparent are they with the due diligence that they provide? Can you check all of their repayment stats? Can you look at how much they've raised, how much they've repaid, over what time period, and what interest level they've given back to their investors? And how can you invest? Can you do it through an IFISA? Can you do it through SAS pension? Can you do it through corporate accounts, or does it just need to be in a personal name? So with Sourced Capital, as I mentioned, we're an FCA regulated peer-to-peer platform. which offers property development loans on a first legal charge basis. Again, if there's any questions throughout, feel free to use the Q&A box. I'll be more than happy to jump through them either as we're talking through each slide or right at the end of the presentation. So we'll start to talk about different terminology, and if it becomes a little bit complicated or you want to know more about it, just ping a question in there. So there'll be a first legal charge secured against the underlying asset, which so far has helped us come to a position where we've got 100% repayment rate. So that is of all capital plus expected interest over the 4 or 5 years that we've been trading now as a business. We offer returns up to 12% per annum. Our average return per annum is around about 11.9%. And like we said, we've got 0 losses. That is of any capital plus expected interest. The stats earlier, you can see at the bottom, the amount that we've raised, just over 42 million. The amount that we've repaid, just over 16.5 million. We've got the interest that's been repaid to our investors to date at 2.8 million, and our average loan to value to GDV. So again, we've done previous webinars discussing peer-to-peer and loan to values in a lot more depth. Today it's purely based on the IFISA, but loan to value to GDV, how much is being raised as the loan amount to how much that end development value will be worth, as we are talking about property development loans. We are an IFISA provider of the year. So last year we was voted best IFISA provider at the Peer-to-Peer Finance News Awards. And Stephen Moss is our managing director, as I mentioned before. And it's a quote there from Steve just mentioning how hard we've worked as a team to be able to bring an offering to our investors, which allows them to invest into one of the most powerful asset classes in the UK, being property, through a tax-efficient manner. So how does it actually work? Investors choose a project that they want to be involved into. That's a property development. Generally, it's going to be a short-term loan. You pick exactly which project that you want to invest into. The money is then lent to the borrowers via the Source Capital platform. So as we're peer-to-peer, we may have a number of investors that want to invest into one particular loan. We raise all the capital. That's then released to the borrowers in stages throughout that development to allow them to complete their property projects. Once that property project has been developed, the funds then are released back to our investors upon the exit, whether that's either refinanced or whether that's sold on the open market. And at that point, investors can choose exactly what they want to do. They can either decide to reinvest into a new project, they can withdraw the funds and invest it into something else, or they can do an ISA transfer and transfer it into another wrapper with another provider. So a little bit of a different visual on that. As you can see, a number of investors all investing into the FCA regulated CAS 7 account. Those funds then are released to the borrower via a loan, which then provides security in terms of the first legal charge, company debentures, there's a borrower's equity that's gone into the deal. At that point then, the platform ourselves takes fees, and then once the project's repaid, that's when the investors earn their interest. So on both sides of this equation, we've got investors and then we've got borrowers. So often we have an overrun of people coming onto the webinars which are looking for funding for their property developments. And then other times it's purely looking at hands-free investment to be able to earn a return over time. So I'll just launch this just to see if there's anyone in the room that is a property developer and may potentially be interested in having funding for their property developments. Surprising, we've got quite a few developers in the room. So what I'll do is I'll send over details. So we did a funding webinar yesterday. My colleague Chris Kirkwood ran a how to have access to funding for your property developments. So after the webinar, I'll send through a link which will have details of that webinar and you'll be able to watch through it. So that's good. So let's get into the battle. Let's run through the IFISA versus cash ISA. What are the benefits, what are the negatives, what can you do with them, what can't you do with them? And then we'll go from there. This one we'll run side by side. So the benefits of a cash ISA against the drawbacks of an IFISA. So the benefit of a cash ISA, it's accessible to all savers. Anyone can have a cash ISA. Anyone can fund it, obviously over the age of 18, can fund a cash ISA. Whereas an IFISA, it's an investment account. It's an investment into a higher risk strategy. So investors must be high net worth or sophisticated. It's easy to access a cash ISA, often throughout your online banking. When you're doing any type of transactions, you'll see a link to open an ISA, link to open multiple fixed or standard ISAs. Whereas with an IFISA, they're not liquid. They're quite difficult to access. You have to wait for the opportunities to become available. But once they are, you're invested in for the duration of that project. With a cash ISA, you can deposit extremely low amounts, £10, £20, £50, whatever it is. With a IFISA, it's often higher entry levels. So with ourselves, Source Capital, the minimum investment is £1,000. Any investment from £1,000 to £20,000 would give you a 10% return per annum. Any investments above £20,000 would give you a 12% return per annum. Safety is a huge benefit of a cash ISA. It's covered by the Financial Services Compensation Scheme for up to £85,000. The drawback with that is that it's covered up to £85,000. Once you get above £85,000, you have to then diversify into different cash ISAs. Whereas with a IFISA, it's secured by property investment, by property assets themselves via a first charge. But the capital is at risk and it's not covered by the Financial Services Compensation Scheme. With a cash ISA, you don't need any understanding of the product, really. You need to know if you're fixed in for a term. You need to know if there's any penalties if you want to withdraw the funds early. But that's it, really. You don't need to know what the risks are. You don't need to know what the potential pitfalls are. You don't need to understand any further information about it. Whereas with an IFISA investment into either peer-to-peer with ourselves, Source Capital, or elsewhere, you need to understand the asset class. You need to be fully aware of what you're investing into, how long you're investing into it, and what type of investment that is, whether it's into a business, whether it's into a property development. We make it completely transparent what investment you're moving into and how those funds will be deployed throughout the duration of that project. With a cash ISA, it's convenient. It's generally quite easy to open. It's easy to access the funding should you need to. It's easy to close at the back end. With an IFISA, you have to have a level of time commitment. It isn't overly complicated to review the projects that we have. However, you do need to allocate a certain amount of time to make sure that you're completely comfortable with that investment, to make sure that you know how long the duration is and everything else that we've run through so far. But the other benefit to a cash ISA is that it's generally a higher interest rate than what's in your access account. So if you've got a general savers, if you move into or study different cash ISAs, you can generate a slightly better return than what you currently receive. Let's do it on the flip side now. So the benefits of an IFISA against the drawbacks of a cash ISA. We'll run through all the benefits of an IFISA first, and then we'll go into the drawbacks of a cash ISA. So the great thing is you have a social impact with an IFISA and investing into peer-to-peer. In peer-to-peer, all parties, all three parties should win. The investors are earning a return for their investment into a development or into a project. The developer, in our case, the borrower, is able to generate income through developing the properties and having a return that way. And then you've got the platform in the middle that facilitate that loan, that complete the due diligence, that generate a fee from it. You have potentially higher interest rates for investing with a IFISA than you do a cash ISA. You choose the investments that you're in. It's a direct investment into a specific opportunity. And you can diversify that into many different opportunities should you wish. It's easy to manage all of the loans and view what you're invested into and have complete sight of your portfolio through online regulated platforms. And the investments with IFISAs are often secured, whether that's a first charge, a second charge, whether it's a company debenture. With ourselves, we only deal with UK property developments, and with all of those, you get a first legal charge. As a platform, they should be transparent. They should be allowing you to see all due diligence. They should be giving you updates throughout the long term. With ourselves, you receive a RICS valuation report. You receive a monitoring surveyor's report every 4 to 6 weeks during a investment that you've made with Sourced. You'll receive an update. That update will be both from independent professional services as well as from ourselves, which you'll be able to get a complete clear picture of what the investment is doing with us. The drawbacks of your cash ISA, even though they're slightly higher than a regular savings account, they are low interest rates. There's two types of cash ISAs. You're either fixed in for a duration or you've got an instant access cash ISA. The fixed term ISAs range from 1 year to 5 years. They offer a better return than an instant access account generally, but you are in for the duration of 1 year, 2 years, 3 years, 5 years. If you wish to withdraw early, there's generally quite severe penalties for that, but it is penalties on the interest, not on the capital that you've put in. Are you at a tax disadvantage by investing through a cash ISA and having other investment classes or asset classes working outside of an ISA? So if you're earning a better return that could be through an ISA, but you're doing it through cash and you've got a cash ISA, you could be at a tax disadvantage, which over time would make a huge amount of difference. You potentially have an inflation risk. If you're investing and you're receiving a return of 3, 4, 5%, but then at that point, your inflation's running at 10, 11%, your money's still losing money. Whereas with other types of ISAs, you are potentially able to keep up with inflation, if not beat it. And Martin Lewis has recently, after being an advocate for so long of cash ISAs, come out to say, ditch the cash ISA and earn more. Here you can see that in a graph. We've got the estimated returns per annum. The cash ISA is utilising the best instant cash ISA in the market currently, which is around 3%. The 2-year best fixed ISA is running at 4%. Sourced Capital Innovative Finance ISA is running up at 12%. So the difference yearly is huge. The difference over a period of time where you're compounding that interest is enormous. So investing with Sourced Capital and the IFISA, how can it be done? There's a couple of ways that you can invest into the IFISA with us. You can create a new IFISA. That's nice and simple. It takes a couple of minutes to do. All of it's through an online portal. So firstly, you'll register an account if you're a new account holder with Sourced. Once you've registered that account, you'll then go through a process of creating the ISA, and it'll take no more than minutes. You can create multiple ISAs throughout a financial year, and you can fund multiple ISAs throughout a financial year. A lot of people believe that you can only fund one IFISA per annum. That isn't correct. You can only fund one of the same breed or same types of ISA. So if you've invested into a stocks and shares ISA for £10,000, you can't invest another £10,000 in another stocks and shares ISA. And you will always be subject to a £20,000 allowance that refreshes every single year. And it is on a use it or lose it basis. So if you've not utilised this year's allowance and you've got funds sat there that you're looking to deploy, it'd be a great thing to try and utilise that before we move into the next tax year. Otherwise, you lose this year's allowance. The other option is to transfer your existing ISA. So that can be done. It's relatively easy to do. And what you would do is you would initiate the transfer from the provider that you're looking to move to. They'll then liaise with your current provider to transfer the funds over. There are a couple of key elements to look at first. It's looking at what the transfer fees are. A very few providers do charge a fee for transferring the ISA, but it is important to check with both the current and the new provider. What I would suggest as well is checking with your provider before you go with them. Are there any fees for transferring out once you're at the back end of an investment? Oh, I've got a couple of questions coming through here. Is a 20,000 spread around all types of ISA, or allowed to invest 20,000 in each type separately? No, so the 20,000 allowance is the maximum that you can invest into any of the ISAs, and that's a combined total. So if you want to put 20,000 in one ISA and 20,000 in another, you can't do that. If you want to put 10,000 in one ISA and 10,000 in another, you are able to do that. I hope that makes sense. Yeah, perfect. Again, any more questions, just let me know. We'll be able to run through it for you. A great question, actually, that I don't know if I'm mentioning next on this slide, but yes, you can transfer a stocks and shares ISA to a cash ISA or into an IFISA. Likewise, the other way, you can transfer an IFISA into a stocks and shares ISA or into a cash ISA. You can do partial or you can do full transfers. So if, let's say, you've built up your ISA year after year after year and you're sat on an ISA portfolio worth £200,000, if you want to transfer a segment of those funds into another ISA, you can do that. One thing that is worth noting with mainly a stocks and shares transfer, to be honest, is if you're initiating a transfer from one provider who you're moving to, sometimes you can do that with either a cash balance, so if you've liquidated whatever assets you've got, or you can do it where at the point of transfer, they close the trades. So then you're sat with capital cash to be able to transfer over. The issue with that is if the stock market has a bad few days in between submitting the transfer to getting to a point where the funds are transferred, you could be at a point where you're at a position that you're at a lower equity level than what you expected. So what I usually suggest to investors that are looking to transfer stocks and shares ISAs, get to a point where you're comfortable to close the trades, have it sat as liquid capital before initiating that transfer into another provider. I've got a question regarding ISA age limits and age restrictions. The only age restriction that you have is that you need to be over the age of 18 to be able to either open or transfer an IFISA. And I've got another question. If I've got 5-year ISA, can I put 20,000 each year? End of year 5, I can generate 100,000 in total. Yeah, so what you would generally need to do or need to be aware of is if your current ISA allows top-ups annually, if you've got a cash ISA, what happens most of the time is that you would invest into whatever that new opportunity is with a cash ISA. So let's say if you've got a 5-year fixed ISA with Barclays, and then a year after you want to put another 20,000 in, that will probably need to go into another either 5-year or 3-year into a separate product. With ourselves, it's quite easy because the projects are pretty straightforward in terms of what they are. The short-term loans, 12 to 18 months generally, you'll invest into one project with up to 20,000 if it's fresh capital. At the end of that project, those funds will be returned back to yourself. You'll then, let's say everything goes well, be sat with £22,000, £23,000. You can then insert another £20,000. So in total, you've got 42, 43,000. You can then either deploy that into one project, deploy that into 2 projects, diversify it into many different projects. It's completely up to you. So then one of the questions that came through is regarding an ISA transfer. Is it also limited to £20,000? The answer is no, it doesn't or isn't subject to the ISA allowance for that tax year. So if you've built up your ISA to £200,000, you can transfer 50,000 to one provider, 100,000 to another, keep 50,000 where it currently is, and also add another 20,000 into your ISA, because it's just fresh funds that account to the allowance in the tax year. Once you're doing the transfers, quite a lot of investors ask me, can I not just transfer it back to my bank and then transfer it into the ISA? If you're investing less than 20,000 and you've no plans to utilize your ISA anywhere else within that same tax year, you can do. However, once you've built up that ISA portfolio, always try and keep it within the tax wrapper. So doing official ISA transfers from one provider directly into another provider, just to make sure that you're not losing any of your allowance over time. So I'll jump back one slide first, because we've talked about different types of ISAs and how they work, and some of the questions have been really good regarding more technical aspects of what you can do with ISAs. One thing worth looking at with an ISA provider is to check if they are a flexible ISA, to see if you can pull that money out and put that money back in within the same tax year effectively, or into another tax year. So if you've got an investment with Sourced and that runs 18 months, at the end of the 18 months, in theory, you can pull that money back out into your bank and put it back into the Sourced IFISA within the same tax year, and it doesn't account to your allocation for the year. I know it starts to get a little bit complicated when you talk flexible ISAs, but worth a question of your ISA provider when you're looking to make an ISA investment. Are they a flexible ISA? Will they allow you to pull money out and put money back into the ISA within the same year, providing the funds are liquid? Three good questions that have come through as well. I'll jump into them towards the end, actually. So what we'll do, we'll get through this slide. We'll pop up another question. Obviously, we've got Source Capital and how we operate as a business. The loans that we operate are fixed-term loans into property developments, which are secured by first charge. If anyone wants further information regarding the Source Capital side, I can send through a guide. I can send through an example project. We can have a bit of a discussion regarding how it operates and how you can earn a 12% return per annum. And then we'll get into the question and answer in a few minutes, because there's quite a few questions going through, which is great. It's exactly what we want. We want people to be interactive. Talking about ISAs can be quite boring if I'm just talking to a screen. So yeah, some really good questions that we can hone in on, really. Just keep this up for another few seconds, just so a few more people, if they want to get a little bit more information on Source Capital, just click yes. If not, either ignore it or just click no. Right, let's skip through this and let's get on to answering some of these questions after we get over the next slide or two. So we've touched on it so far. The ISA deadline is the 5th of April this year. It soon approaches. So anyone that is looking to make a move and make an investment, that's one of the key dates that you need to look at. A lot of the questions that I've had so far regarding the 20,000 ISA limit and how that works, the timing for somebody who's not used their ISA this year is great, because within the next 6 weeks, 7 weeks, whatever it is, between now and the 6th of April, you can effectively deploy £40,000, 20,000 this tax year, 20,000 next tax year, and it can be a day in between both of them. So a bit of a summary. Obviously, I'll leave that on. We've all seen it so far. I've talked about it quite a lot. Let's get into the Q&A. The series of webinars are starting with the cash versus IFISA. We have got another webinar that will be taking place on the 23rd of February. It will be in the middle of the day rather than in an evening. So hopefully that's a little bit better for a few people. And with that, we'll be talking about how to become an ISA millionaire. Let me try that again. How to become an ISA millionaire and how you can do that utilizing an IFISA and investments with sourced capital. We'll talk about compound interest. We'll talk about the power of that, and we'll look at how investing smartly over a number of years allows you to generate huge amounts of wealth. I'll leave that one on for a minute or so. There will be a link sent out to everyone as well. So if you're not able to scan it because this is on your screen, that's fine. So let's get into the Q&A. There's a few questions that I've kind of skipped through that I'll go back to. So the first one that I've got here is you quoted a return of 3,000 on a 20k investment over 12 months, 15% return. What are the commissions / fees does Source Capital take? So I'll break that down into two segments. The first one being the return. The return is 12% per annum. So if it's a 12 months project and you've invested 20,000, you'll receive 12%. If it's a 15 months project, you'll receive effectively 15% because it's a 12% prorated. The fees / commission the Source Capital take, it's completely transparent. When we go through a project report and you see the investment itself, the report's around about 15 pages. In that report, there's a financial breakdown for the project itself, for the borrowing and the cost of finance. We take two fees. It's 2% at the front end from the borrower and 3% at the back end. So we take a 5% fee from the borrower. There are no fees from your point of view as an investor. The next question is, can you invest 20,000 cash into an IFISA, then transfer another 20,000 more from a stocks and shares ISA to an IFISA in the same year? Yes, you absolutely can. The fresh funds doesn't equate to anything that you can do with your transfers. So you could transfer 20,000 from a stocks and shares ISA into an IFISA, providing that was invested in the previous tax year, and then you can put another 20,000 in this tax year. Can the interest add up to 20,000? Yeah, the interest can be whatever amount in theory. So again, going back to the example of if you've got a 200,000 pounds ISA and you're receiving 24,000 pounds interest per annum, the interest that you receive doesn't deduct from your allowance. It's just of fresh money coming outside of the ISA into the ISA. So if you've got an ISA worth £1 million and you're generating, let's say, £100,000 worth of interest, you can still put another £20,000 worth of fresh capital into the ISA in the year. That's fine. I can send over details of the ISA. I've got an ISA guide that I can send through that we'll be doing. I've got a question: over what period does Source Capital achieve the results shown on your earlier slide, showing total loan, average return, and losses? That's over 4 years. So every single year we'll update, well, every single time there's either a drawdown of a new loan or there's a repayment of a current loan, we'll update the stats page. Every year we'll do a breakdown in terms of what the average return was to investors, either 10 or 12%. And that's been over the past 4 years. We're due quite a few repayments over the next few weeks. So we'll see that stats page alter quite significantly. And we have got quite a few new opportunities coming through. With a raised potential of recession globally, that is likely to impact property prices, why would I want to invest in an IFISA with that sort of risk looming? Absolutely, great question. That is part of investing. There are risks involved. Obviously, those risks are different at any time of the year. Or 2 years ago, there was COVID. A lot of investors stood by and didn't want to invest. A lot of investors did still invest. Throughout a project, there'll be specific finance terms. There'll be amount raised against how much the property will be worth. So that's your safety margin throughout that loan. Effectively, you become a bank in this situation. You're not taking the same risk as what a developer would be taking, where they've put their capital into the deal and they're an equity beneficiary effectively. So with yourself, you put in an investment. So the latest investment is Cuddy Hill, which is a development of 2 houses in Preston. The loan to value on day one was 50%. So there's a 50% safety margin for how much we're raising as a platform to how much the land is currently worth, to then a total loan to value to GDV of just over 60%. So again, there's a potential for a 40% market decline before investors' capital is at risk, but it is 100% worth thinking about. And again, we'll relay all of our due diligence back to independent professional services. So there's been an independent valuation report that's taken place. There's been an independent monitoring surveyor's report that will indicate the cost of materials, that will indicate the cost of the build, that will also indicate the GDV, what the property will be worth once the properties are developed. And it is a short-term loan, it's 6 to 18 months, even though the world is unpredictable at the minute, and it has been for the last 3 years, really. You are able to see quite a short way into the future. We're not talking about a huge hotel that's being developed that'll take 5 to 10 years. They're generally small, single properties, multiple units, nothing crazy. The small, medium entrepreneurs, really. I hope that answers it. Obviously, we could talk about that in a huge amount. Actually, I've done a webinar in the past that what I can do is I can try and find the link and send it over to you. If you can just pop your email address, John, into the chat, I'll try and dig that out and send it over. You mentioned 20,000 or less earns 10% and more than 20,000 earns 12. Why the difference? So if I invest 19,900, it'll be 10%, but if you invest 20,100, you'll get 12%. The amount is 20,000 or more. So a lot of IFISA investors want to know, if they put 20,000 in, will it be at 12%? It will be, it'll be at 12% per annum. The reason we do that is because having a lot of investors which are invested in takes up a lot more time from ourselves as a platform. Therefore, there needs to be a built-in margin. So we will take the margin. We charge the borrower a 12% rate. Anything under that, obviously, it's a 10% return to our investors. We take a slither of a margin. Question regarding the if somebody outside the UK can invest into source capital projects and earn 12% per annum. So what we've talked about today doesn't really apply to you, unfortunately. The IFISA is only available to UK residents. The great thing is you can still invest into source capital projects and you can still earn 12% per annum. However, it wouldn't be able to utilise a tax-free element. How do you vet the projects you list on your platform? So they go through an extensive due diligence process, and that then culminates in an investor report, which is about a 15-page report running through the project, running through all the financials, who the borrower is, looking at what the development is, what the exit strategy is. So we put all of those risk points or project points into an algorithm, and then that'll generate a risk matrix for us to look at. Alongside that, we do standard credit fundamental checks of the borrowers, of the deal itself. Everything that we look at, again, relates back to professional services, which are independent from us, independent from the borrower, and they are RICS surveyors, which will assess the project from its value currently to the value at the end. The follow-on question from that is how the risk level has shifted given the current interest rate set by the Bank of England. So there's two elements to that, really. The first one is, has our interest rate changed for borrowers and or investors? No, we stayed at 12%. Over the past few months, we've not changed. The exit strategies for some of the developments have been impacted. Again, it's part of the process of making sure that the loans that you're taking on are fundamentally sound. So if there is a continued interest rate increase, are the developers that are looking to refinance the deal still able to refinance them, or do they need to sell them? If they need to sell them, will they potentially need to reduce the sales value to be able to still attract buyers? It's part of our process of due diligence to check to make sure that there's a good exit strategy or viable exit strategy in place, whether it's a refinance or whether it is a sale. Obviously, the current interest rates have risen quite significantly over the last few months. We're all hoping that that'll kind of slow down to a more stable position. The property market has felt a bit of a slowdown, but nothing too significant really. Can I add 20,000 every year in the same cash ISA? You'll be able to put it into the same company, i.e. Barclays, Nationwide, whoever you bank with. The likelihood is, unless it's an instant access, you probably wouldn't be able to put it into the exact same product, because generally if you're in a fixed term, you'll be fixed in for a certain amount of time. You wouldn't be able to top up and then be still fixed for that time period. You'll then likely go into a new period. So you'll probably be into another 3 years, 5 years, etc. I've got a few more questions. I'll go through them in just the same order that they come in. Let's say you invest in a project for 15 months, you get a 15% return at the end of the 15 months. However, at that time, if you haven't got another project, the amount will just be sitting in an IFISA without any interest earned. Yep, absolutely correct. That's why at the beginning of the webinar, we was talking about transfers, and we'll talk about you can do whatever you want when that money's back to you. Generally, we have 2 or 3 projects per month to allow investors to invest into, whether that's to diversify into different projects or whether it's to put the capital into one project. But when it is sat in the IFISA, not invested into a project, it isn't earning any interest. That's where we come in as a platform to try and educate our investors in terms of what deals are coming along when they're coming to the end of their duration of a loan. But that is absolutely correct. Once it's sat there, it isn't earning any interest, but there will be more than enough opportunities to come into. And you don't need to invest into every single project. So let's say if you've got a return and you see 3 or 4 projects come through that you're not overly keen on, they don't tick your boxes as an investor, you can just move on to the next deal, move on to the next deal until you're fully 100% comfortable with that investment and the duration that it's involved for. Who screens the property development opportunities as robust, viable projects with a good prospect of return? That's our role at Source Capital for facilitating the project. A developer or borrower would bring the opportunity through to us. We would review that. We would then conduct all of our due diligence on that project. We then release the report. We release the independent reports to our investors. It's then up to them whether they wish to invest into that project or a different project. I've got some investors that really like new builds but don't like small refurbishments. I've got some that like small refurbishments but don't like new builds. I've got some that love the Northwest as an investment area. I've got some that hate the Northwest as an investment area. Again, it's hands-free. You don't need to be close to site, but some investors have got certain criteria that they want to stick to. But we'll do all of the due diligence on the deal to make sure it's robust, to make sure it's viable, and make sure it's got a good prospect of return. And then it's up to our investors to review that project to make sure they're comfortable with it. So if I invest 200,000 and the developer defaults and Source hold the first charge over the asset, will Source then take the security to auction? Good question. One that we'll go into. So yes, the security is held separate to Sourced as a business. So if Sourced go into administration, if Source cease trading, that development, that defaults will still be able to be recovered for our investors. And it will be a appointed receiver who's put in place by the security trustee that holds security on behalf of the investors to sell that property for effectively as much as possible to repay the loan plus the interest plus fees that have accrued. That's where you look at an investment to review the loan to value to whatever the GDV is, loan to value to whatever the purchase price is, to make sure if in that worst case scenario, there's still plenty of safety margins throughout. I've skimmed through that pretty quick. Obviously, that's quite an in-depth topic. If you can just pop your details in, I can more than happy have probably a half-an-hour conversation running through that. Have you got any examples of current/past investors investing 20,000 with you, and what were their returns? Yeah, Everything's based online. So we've got a statistics page on our website that shows every investor's annual returns over the 4 years that we've been trading. We are FCA regulated. We need to publish those audited accounts to the FCA to show what investors are receiving. Other than that, we have got Trustpilot. So we don't really push Trustpilot too much, but I think we've got 50 or so reviews on there, which will talk about investors' experiences throughout the duration of being invested with us. Question, is it only the first charge you hold, or do you also hold a personal guarantee? Yeah, there's multiple layers to the security. So firstly, you've got the first legal charge, because that is effectively the security with the most power. It's a right for repossession. It's a right for repayment first. There is a personal guarantee against the developer, because the loan is against a SPV, special purpose vehicle, a limited company that's been created for the purpose of that development. So all developers within that loan would also have a personal guarantee for a value. Personal guarantees are very difficult to enforce, but it formally links an individual to an SPV, a borrowing SPV. Somebody knows a model a little bit better than what I've explained. Do you need to be a source franchisee to be able to borrow through sourced capital to fund any projects? Yes, you do. So again, when we're reviewing the deals that are coming through, we know who the borrowers are. They're part of our franchise network. We've got over 185 franchise offices throughout the UK now. We're not reliant on brokers. We're not reliant on third parties coming to us, which helps us review the deal first before we even start to do our true due diligence on the project. So yeah, very good question. And the answer is, yeah, you do need to be a source franchisee. Not relating to ISAs, however, do you think it is best to invest through an IFISA or better to invest in property through property SaaS? Good question. It's a question that I've been toying with myself, to be honest. So I do an awful lot of my investing through ISAs. I've built my ISA up over probably the last 6, 7 years. Every year putting 20,000 in plus the returns that I get through the investments. The great thing with an ISA or an IFISA, whichever ISA you're in, is that you can withdraw those funds at any time, providing you're in cash rather than in a specific project or in a fixed term. Which means then if you want to buy a car, if you want to buy a house, if you want to access those funds, you can do. The downside with an ISA is that it's funds that are already in your personal name, so you've already been taxed on them. So a lot of people say, oh, ISAs are tax-free, they're great. Yes, they are, but you have been taxed at some point on that money that you've got in your bank, income tax generally. So a SaaS, you can invest, or you can divert your earnings into a pension, and then you can invest it into a property development, or you can buy commercial assets, or you can do weird and wonderful things with it. It's dependent on your strategy, really. That's probably the best way to look at it. A lot of our investors invest through SASs and ISAs. They don't look at it as one or the other. They have a blended investment approach. Again, you're limited on how much you can put into your pension per annum from earnings or through the company. So it depends on what your strategy is, really. For myself, I'm more heavily focused on ISAs because I'm 28 years old now, so I'm looking at today rather than in 30 years when I can actually draw down monies from a pension. Is Source Capital due diligence expertise in finance or due diligence? Finance or includes due diligence / expertise in property? Both. So we've got an in-house credit team, which have got years of experience in both finance and alternative finance. So peer-to-peer outside of Source before they join Source. And we've got directors with over 100 years experience within property. So the majority of the experience within Sourced as a group is within property, obviously because what we do is purely property led. But there is a huge wealth of experience within finance itself and within this space of alternative finance, peer-to-peer. I've got one question popped in. I've not had any questions for the last few minutes. So if you've got any more questions, pop them in. We'll try and get off by probably about 8:05 if we can do. If I had 20,000 in cash in a cash ISA this year, I'm not allowed to pay 20,000 for the next tax year in the existing ISA. You can do. It just depends on what the structures are with whoever you're investing with. So with ourselves, if you put 20,000 into your IFISA, generally you'll put that into a project. So those funds are working. That project then is closed. It's locked for investment. So you can't put any further funds into it. You would have to, once you invest into the next tax year, you would have to put that into another project, which is good for diversification anyway. If you're talking about cash ISAs, it purely depends on who you're investing with, whether they allow further investments into the ISA if it's a fixed term. If it's an instant access cash ISA, yeah, you'll be able to put 20,000 in and then 20,000 in next tax year. There won't be any issues with that. But if it's a fixed term ISA, you'll need to check what the restrictions are and if you'll need to go into a separate product. There are no more questions coming through. I'll leave it a minute or so, but feel free to leave now. It's been quite a long webinar. I expected it to probably be about 45 minutes, so some great questions. We've run through a lot more than probably what I would have generally gone through. Oh, we have got more questions. Here we go. I didn't scroll down. How big is your team / company? There's two ways to look at the size of the company. In terms of the franchise network, we've got 185 offices. In terms of the sourced team, we've got around 30 members. New to this, can I do this through a limited company? You can invest through a limited company. Yes, you can invest into the projects we source through a limited company. What you can't do is utilize the ISA as a limited company. It's an individual savings account, so it's specific to an individual. So if you took money out of your limited company into your personal name and then invested it into the projects, you can do it through an ISA. But if you wanted to just invest directly through the company into a project, yes, you can do that through a limited company. You can do it a blended approach as well. If you wanted to do 20,000 in your ISA for your allowance, and then you wanted to do another 50,000 in cash, just because you've got personal wealth, which is more than the 20,000 allowance, and you've got 100,000 in your limited company that you need to deploy, you can do all three. There's no issue with that. You can diversify that into different projects, put it into one project, however you wish to invest it. Is IFISA specific to property only, or can it be used for alternative assets? The IFISA is designed for peer-to-peer or crowdfunding. So there's many different platforms out there which will allow investments into property, into businesses, into individual loans, into direct loans. So yeah, there's a huge amount of options, but it is peer-to-peer or crowdfunding that you can use an IFISA for. Perfect, not a problem. Any more questions before we start to shut down the webinar? Thank you very much for being so interactive as well. It's great to actually have conversations through the webinar and actually get into deeper points rather than just what we've put on there to say, well, people will like to see this. It's great to actually get into the nooks and crannies of the investment and the asset classes. Perfect, we'll leave it there then. Thank you very much to everyone. Have a great evening. I know we're just over the hour mark, so the next webinar for anyone who's interested is midday. It is on a second part of this three-part series leading up to the ISA deadline. It'll probably be around about half an hour. We'll be straight into a topic of how to become an ISA millionaire, and then we'll follow on from it into another webinar, which is regarding the deadline and how to avoid missing that deadline. So thank you very much, everyone. I'll see you all soon.